Do you want to own 100 shares of NVIDIA stock, but right now you feel like the stock is just a little too high to be buying shares? Today I want to talk about an option strategy that I'm using when I feel like any stock is a little overextended and I don't really want to buy it up here when I'd rather buy it down here. And I think that a pullback makes sense because I'm looking at the moving averages. They look a little extended. I sell options to fund my life of freedom, and the stock market is my primary source of income. Now, naked puts, selling naked puts is my most favorite strategy. But when you sell puts, when the stock market is at all-time highs, you're setting yourself up for a house of pain. Even if it's temporary, even if you're not over leveraged, you're going to take some heat if and when we finally get that pullback. Today, I want to talk about this option strategy of selling put spreads, but not in the traditional way that a lot of people think about it. Let's talk about it today. Let's look at an example. We'll use NVIDIA stock as an example. I will show you exactly how I think about selling a put spread versus selling just a naked put. We're going to collect a little bit less premium upfront, but we have a little kicker insurance policy. If the stock pulls back, we are going to still buy our 100 shares of NVIDIA. We're going to collect an additional credit, and we don't have to just sit on the sideline and wait for the stock to pull back. We're going to get paid while we wait. Let's hop into the options chain. Let's hop into the chart. Let's look at NVIDIA. It's going to be a great video of how I make some additional income when markets are a little extended, but I mean, they can keep going higher, I know, but when that pullback happens, we're going to make some additional capital. This is NVIDIA's chart. I like to combine charts and the math-based options chain together, and I keep it really simple. This is my chart of NVIDIA. When you look at my chart, you're always going to see the same 5 lines on every single chart. I love moving averages. If you want your chart to look like mine, check out the comment below. I'll have a link to make your TradingView chart look just like mine, because I'm telling you right now, one of the biggest complaints I get from people in my community is my charts don't look like yours. I put up the free guide. Check it out in the link below. You can see here, this really thin blue line is the 10 EMA. This is the 20 EMA. This is the 50 EMA. You're like, what does that mean? Give me 1 second. This is the 100 simple moving average and the 200 simple moving average. All a moving average does is it looks at the last X number of candles. So like I said, 10, 20, 50, 100, and 200. It takes those last candles and it gives us the averaged out price. Now, I'm not going to get into the technicals of why I use the EMA versus the SMA. The EMA kind of just shows like a little bit better math of getting the average price for the shorter time frames. But just think of it this way. This blue line here is the 100 simple moving average, meaning that the last 100 trading days, so we're talking almost 2 years of data here between this red line, this blue line, almost the last 2 years of data is averaged out into the price of between 191 and 187, 188. Right now, NVIDIA's trading at 215. That means that we are 12% above the last 100 candles. I don't know about you, but I like to buy low, sell higher, right? Right now, you're buying NVIDIA at a premium over the last 100 days. Is that good? Is that bad? You could make an argument either way. I know previous performance isn't indicative of the future results, but for me, I like to look at the past and figure out where would I like to buy NVIDIA again. And really quickly, I'll show you why. If you look at Apple stock, one of the questions I get all the time is, where should I buy a stock? Well, if you bought Apple off of the blue line on the weekly chart, you would have bought Apple 7 to 8 times, and you would be up a substantial amount of money. Now, if you just held Apple the entire time, yes, you would still be up. But where do you buy? Where do you sell? You buy off the blue line every single time. This is just a strategy that you can have to keep things simple. So when we talk about where do you buy NVIDIA, well, you buy it off this blue line. And yes, sometimes it dips a little bit more, but buying off the blue line is a great place to pick up some NVIDIA stock. Even if you made it through this little bit of a pull down, NVIDIA came back. I would much rather buy NVIDIA off of this blue line than buying it up here, or heavens forbid, you buy it at like 235 at the all-time high. Will NVIDIA be higher than 235 eventually? I think it will, but how long? How long are you going to hold those shares? How are you going to feel when you look at your stock portfolio and you see that you're down X amount of dollars? Let's talk about selling a naked put first of all right? Where would I want to sell a naked put? Well, I'm going to go and look at the options chain in just a second, but just looking at the chart itself, I know I want to get it somewhere around 191, 192, because that's where the 100 simple moving average is. If you go out here, let's just say for rounded purposes, we'll just say you sell the 195 put. Now, I think you know this, but if you sell a 195 put, you're just saying, hey, I am obligating myself to buying 100 shares of NVIDIA at 195. And in exchange for selling that put, you're going to get paid upfront immediately in your account, something called premium. You'll probably get maybe $300 to $500. We'll look in a second for the exact number, but you'll get like several $100s for this agreement to buy NVIDIA. Now, if NVIDIA stock goes up, everything's great, you keep your money. But if NVIDIA stock starts doing this, let's just say it keeps going down and down and down, and eventually it hits like 192, and you've sold the 195. You are going to start looking at your broker, and you're going to look at the paper loss of the option. It's going to look like you lost a lot of money. Now, you really haven't lost as much money as it looks like. It's just as you sell a naked put and the stock pulls back, that option becomes more valuable. And when you sell something, let's just say if you're selling bottles of water, whatever it is, you don't want the bottles of water cost to go up and up. If you're selling them for $1 and someone else is selling them for $5, you're losing out on that extra profits that other people are selling at. So what I'm saying is if you sell that naked put and you have a pullback, you're going to start losing some money. But if you go out and you sell a put spread, let's just say you sell the 195, but you go and you buy the 190. So I'm going to just kind of draw a line here. I know it's not straight, but I want it to be different colors. So we bought a put here, right? And we sold a put here. So we've obligated ourselves to buy 100 shares of NVIDIA at 195, but we have the right to sell those back at 190. So if NVIDIA stock does this again, it starts coming down, this sold put loses value, but this long put, it appreciates. And a lot of people talk about selling put spreads as a risk-defined way. They put them on together and they take them off together. I don't want you to think of it that way as long as you are okay owning 100 shares of NVIDIA stock. Because if you're okay owning 100 shares of NVIDIA stock, I want you to think of this almost as two separate trades. We're putting it on together, but you're obligating yourself to buy 100 shares at 195. But you know in the back of your mind, I have an insurance policy. You can sell your shares right here at 195, 190. Where this long put is. And I know you don't have the shares. You don't have to have the shares to actually execute this trade. It's called unraveling a put spread, and you can make it super complicated or you can make it super simple. I elect to make it really simple. I think of it this way. If I sold that 195 put by itself, I'm obligating myself to buy 100 shares of NVIDIA at 195. As the stock pulls back and it gets tested, as my strike gets tested. So as soon as this stock gets tested right here, right? Forgive my really crude drawings, but as soon as NVIDIA stock goes to 195, I get my little antennas go up and I start thinking, uh-oh, I'm getting tested. If I only had that naked put, I'm like, oh man, I'm really losing money. I hope NVIDIA doesn't go to like 150. I've agreed to buy it at 195. But if I have that put spread in the back of my mind, I can sleep really well at night because I know I have the right to sell that long put for a really nice credit. What I do is I start looking at the stock and I think to myself, well, NVIDIA should have bounced here at the 50. It really should bounce here at the 100. And look at all this support and resistance here. You can actually see on my chart, if I scroll back, like NVIDIA has had some support and resistance back here. So it should bounce around 196 anyways. I'm going to go ahead and unravel my put spread as soon as it starts getting tested. So when this goes in the money and it closes in the money, like, let me go ahead, get rid of my right to buy back my shares, and I turn this back into a naked put. But in the process, I'm going to collect another $500-$600 in premium. Let's hop over to the options chain. Now that we've seen kind of the levels on the chart, we kind of know NVIDIA should bounce. It should reverse at the 50 EMA around 203. And if it doesn't, it should definitely reverse where we saw all this support and resistance. We have this short put here. We have a long put here. So the chart says 195, 190 makes a lot of sense. Now I am using Tasty Trade in this example. I also like Thinkorswim, but Tasty Trade does a really good job of showing us the delta and the theta and all the Greeks that are kind of complicated, but they're not once you start learning them. This is the NVIDIA options chain. If you're not familiar with the options chain, Tasty Trade offers a lot of really great education. It's all free. I go out and I'm looking when I'm selling a spread, meaning I'm selling a put and I'm buying a put. I want a little bit more time on my spread. So I need over 30 days to expiration because that theta decay gets really fast inside of 21 DTE. So right now you can see the June options expiration for the monthly option is 20 DTE. That's if I was selling a put, hey, that's a little bit different, but I want to sell a put and buy a put. I'm going to go out to July, 49 DTE. Like I said, if I sold this put at 195 all by itself, my max loss looked really ugly because if NVIDIA goes to zero, NVIDIA is not going to zero, but you could lose $19,500, right? Because that's just how the stock works. But you can look here at the risk curve. Like as NVIDIA pulls back, you just keep losing more and more and more and more money, right? So as it pulls back, you lose more money. But what if we go in there and we set up this spread? So instead of collecting $445, you're going to buy the 190, sell the 195, you're going to collect $110. Now you might be saying, Justin, I would much rather have $500 or $400 than $100. Why are you doing this? Why would you do this? The reason I'm doing this is because I know I'm going to unravel the spread. I'm not going to treat it like a traditional spread where I put it on for a credit and I take off both legs at the same time. And my max loss here is $390 because it's the width of the spread minus the premium. I don't treat it that way. I treat it as this is my insurance policy in case something happens. I know I can get a bonus. So no, if NVIDIA keeps going higher, I just got paid what? Almost $1.09 a day to buy some NVIDIA. Doesn't sound like a lot, but it adds up. It's much better than, hey, let me put in a limit buy and hope NVIDIA comes down to 190 and then I'll buy some. At least here I'm collecting some premium while my cash is sitting in SGov. If you have Thinkorswim or NVIDIA, I know like IBKR and Fidelity, they let you get cash on your return in your portfolio, but I have my money sitting there making about 5% in SGov, and I'm still making an extra $1 a day waiting for NVIDIA to come down to my level, right? So this spread is going to look a little bit different on the risk curve. You can see like the loss looks like it maxes out at, like I said, a max of $390. So the most you're going to lose here, if NVIDIA did go to zero, which it's not, you would lose $390. What we're going to do is we are going to take this spread, just like we talked about on the chart, as NVIDIA. So this is the in the money line, right? So NVIDIA is trading at what, like 213 or something right now. If it comes down to 195, right? This option that we sold is going to be much closer to like right here. That $4 that you would have collected if you sold the naked put, you could have sold that same put for almost $10 because the stock pulled back. It really sucks when you look at that on paper and you're like, man, I could have gotten more if I just waited. But if you have this put spread and you have this insurance policy, you know that this option that you sold might be worth $10, but this option that you bought, it's going to be like this one right here, right? This is a $5 wide spread too. It's going to be worth like I know it says $7 and 50 cents here, but it's going to be worth a little bit more like $6 or $7. So what I do is I'll go in here and I will sell this option at 190 and I converted my trade to a naked put. still agreeing to buy 100 shares of NVIDIA at $195, but I unraveled, I sold that long put for another credit. So I collected $110 on this initial trade. As soon as NVIDIA pulls back and comes to my strike of my short put, I'm going to close that thing out. I'm going to close that long put out. I'm going to leave the short put. Now, if you're a really good options trader, you have experience, you're probably thinking to yourself, well, you could just take that short put and you could roll it out to August and get another credit. Yeah, absolutely. But for me, I really like owning shares of stock right off that blue line because you guys know shares of stock are just like assets. It's just like owning a house. Where do you want to buy the house? Try to get the average price of the last 100 or 200 days and say, hey, I'll buy some shares here. Let those things appreciate. Start selling some covered calls. You can generate income off of covered calls, but you also get appreciation because when you only sell puts, when you only sell options, you don't get that share price appreciation. And a lot of people are missing out on a lot of capital. Like in this bull run, it's been really nice to have some shares of stock, which give us a little extra delta, kind of have unlimited wins when you have shares of stock, whereas we have a lot of defined wins when we're selling premium. I mean, the most money you can make when you sell a put by itself is the premium you collect. So what I'm saying is when you see that stocks are extended, like NVIDIA right here, we're 12% above the 100 simple moving average. It's a good time to think about selling a put spread with the intent of unraveling it when it pulls back. So instead of just collecting that $100 in the back of your mind, you're thinking, well, I'm getting paid to be patient, not buying NVIDIA too high, but knowing when to take it and unravel it with the mindset of, hey, I just made some extra money when NVIDIA pulled back, and I'm still going to get to buy shares of NVIDIA here at 190. Like you have the 195 short put, but if you closed out the long put for a $6 credit, you just reduced your cost basis of your shares back down to about 190. When you consider the dollar that you collected when you set up the put spread in the first place, you're getting NVIDIA at about 189. Looks like a really great place on the chart to me. That's where the 200 simple moving average is. Now, if you're out there and you want to just sell naked puts, go ahead. But that's the house of pain I'm talking about, as the house of pain, meaning you're going to be upside down on paper on NVIDIA. And if it goes to 173, let's just say it retests back to 171, that naked put by itself is going to be underwater. Whereas, yes, you collected more premium in the beginning with the naked put, but when you get the pullback, that's when bad things happen. And I don't know about you, but I see a lot of traders who start getting really nervous when they start seeing these paper losses, or they start thinking about, oh my goodness, in the short term, I'm underwater in the stock, and they close it out at the wrong time. They get really nervous, and that's the worst feeling of all, because normally what happens when a stock finally gets to the point of capitulation and people are like, I can't take it anymore, the stock bounces and they start really hating the stock market. So think about some short put spreads instead of just selling naked puts. You're going to collect less premium in the beginning, but when the stock pulls back and you know how to unravel it because you're getting tested, you have a bonus. And if the stock bounces as soon as you take off your put spread, because remember, we're selling right where it should reverse. So if it takes off, you can actually make the premium that you collected at the front by selling the spread, and you made even more off that insurance policy, and you have a double win. So I hope this video is helpful. I'm going to show you how you can not get called away in our next video. So I'll catch you next time right here. If you haven't already, check out my Paycheck Replacer Blueprint. It's my exact strategy, my exact checklist of how I sell puts to generate income to give me the life of freedom that I have. I'll catch you next time right here. Thanks.